For any founders in the audience, feel free to ask Sam when A16Z is launching a token. I think that'll be fun to flip the script. Next up, I think one of the most important things that's happening with stablecoins today is the cross-border narrative, and especially around emerging markets. So I want to invite Antonio from Bridge, Christian from Third Prime, Ryan from Pantera, and Bernardo from Trace to come and talk about geographical adoption in the US, in Africa, in APAC, and in Latin America, respectively. And we'll have John come back up and moderate because I can't get enough of John. I mean, just look at that handsome face. It's tough to do more.
Appreciate it, Kevin. Kevin said he didn't want a lot of VCs up here, and now we have a few more, including myself. Awesome. For those of you that weren't in the first session, I was just up here. I'm an investor at Flourish Ventures. We're a global fintech-focused fund. We've got people all over the globe, 3 in Africa, 3 in Asia, a few in LATAM. And one of the critical components of what we look at is adoption of stablecoins internationally. And we have 3 folks here across region building different applications or investing in different applications. And we'd love to really explore kind of how adoption is being categorized in different geographies, what's working, what's not, and where this infrastructure is heading next. So maybe to start out, we'll go down the line here for you guys to introduce yourselves, tell a little bit about your company or your fund, and what you do.
Hey, I'm Bernardo Bright. I'm CEO and founder of Trace Finance. We empower some of the largest payments and stablecoin companies down in Latin America. We are processing close to $1 billion in TPV per month. And we are doing volume with dLocal, with Bitso, Dollar App, and many of the other folks, which in turn allows us to process most of the volume for Amazon, Airbnb, Uber, and a lot of other amazing companies that are right next to us here in SF.
Hey everyone, I'm Christian Kaczmarczyk. I work for a fund called Third Prime. I'm here in place for Chris Maurice from Yellow Card. We invested into them back in their Series A, but for those who are unfamiliar with Yellow Card, they are an on and off ramp, as well as a payments company based in servicing most of the people in Africa, as well as a little bit of the Middle East. Third Prime, just for your guys' background, is fintech, industrial tech, as well as crypto. We've been doing stablecoin or stablecoin related investments across the world. So we kind of generally have distribution around the world since 2021. But yeah, happy to give perspectives from Africa, LATAM. I've been fortunate to spend a lot of time around the world to try to see what's happening, boots on the ground. So excited.
Thanks, CK. Hi, everyone. I'm Ryan Barney. I'm here from Pantera Capital. We're a fund that's been investing exclusively in crypto and blockchain since 2013. And through time, that's been a lot of different flavors of stablecoins and orchestration on and off ramps and exchanges. So looking forward to sharing our perspective. And I primarily focus on stablecoins, exchanges, infrastructure, and given that it's been a pretty worldwide lens recently. So looking forward to the conversation.
Wonderful. Maybe to just start out, right, given you guys focus on different geographies or have experience in different geographies, what makes your region especially ripe or difficult for stablecoin adoption today? And maybe Bernardo, to start out with you to speak about Brazil.
Definitely. So I think that LATAM is very peculiar in itself. When you see a lot of people trying to get into Latin America, they think it's everything, every country essentially is the same, right? So you have like Spanish speaking Latin America, and then you have Brazil, which is a big step difference between both. I think that Brazil has most of the volume in the region as well, but also Mexico, Colombia, Argentina are very relevant, and also some of the other countries like Chile are picking up a lot of volume there. But the regulations are so different. And also a lot of the banks in Latin America, they are even, I would say, 5 to 10 years behind what the US banks are. So most of them don't have APIs. A lot of them don't even have a platform in English. When you go into the ones that do have APIs, your US developers now have to learn Portuguese to be able to integrate. And also, there's a big difference on the regulatory stack. If you operate with broker in Brazil, for example, which is the role that Wise plays there, you would have a cap on up to $500,000 that you would be able to operate. And then if you have just an FX bank, you would only be able to do the cross-border piece, but you wouldn't be able to get access to PIX, which I think is an amazing invention by the Central Bank of Brazil and something that we see now in other instant payment systems around the world. But you really need to have the highest stack of regulation in each of those countries. And in that case, you wouldn't have any limitations. You would have the best of both worlds in the sense that you have amazing APIs, but also you are not capped into working with fintech that is capped to $100,000, which is the case for a lot of payment institutions in Brazil. So I think you really need to use the best in each of those countries, or at least get the best in Brazil or the best in Mexico. And then for the remainder of Latin America, you will have almost a very similar experience from all of the other players.
Yeah, and I will echo kind of similar experiences from that Bernardo has in LATAM. Africa also suffers massively from those problems. I mean, when you think about like inflation of your currency, you have 52 different currencies across Africa, so you have to deal with a lot of different money movement systems. Also, those currencies are constantly inflating and never really have clear regulation of what's happening there. So similar problems that you have in LATAM, not that much different in Africa. But I think really the biggest thing that people really want is just being able to get access to the US dollar, right? They want to protect themselves from any sort of inflation that happens there. There's also a lot of people that typically after university, they leave the country and they don't come back for like 50 years. So remittance is a big flow of just sending money back to their region that they're from. And there's usually a ton of costs associated with that, right? You're paying fees from Western Union and MoneyGram. You're also paying fees from the banking and FX. So at the end of the day, like when you send $1 back home, you're probably only getting anywhere from 60 to 80 cents, depending how lucky you are. So by bringing stablecoins into the equation, you also enable the opportunity to just lower the cost for yourself and maintain value. And that was really the premise of why Yellow Card got started, right? Being able to move money from back home from the US back into the African region. And I think another area too is just that like because there's so many currencies you have to deal with it, like being able to exchange is a pain, right? Even just exchanging money from Nigeria and Ghana, although they're pretty much right next door to each other, massive amount of time settlement, right? It might take you 5 to 7 days to settle on this stuff. You might pay some other crazy fees you just don't even know about. So bringing stablecoins to the region is really just bringing so much layers of efficiency across the board, as well as just cost savings. So, yeah.
And I'll do my best to cover Africa. Excuse me, you just did that. Well done. I'll do my best to cover Asia. I think the perspective from Pantera is we, through time, have invested in basically major regional exchanges across LATAM, Africa, Asia, Southeast Asia, et cetera. And what's really interesting is now, as we think about a core crypto user and a core stablecoin user, in most geographies, they look pretty different. A core crypto user is someone who wants to buy Bitcoin, who wants to buy meme coins. Like it's more of like the gambling, speculative nature of the space. And a core stablecoin user is everything we've been speaking about today: remittance, savings, access to US dollars. Across all the regions we invest in, Asia is the most interesting because users there look a lot closer to a core crypto user and a core stablecoin user. We're actually seeing people that onboard into stables more quickly cross the chasm into kind of other next generation crypto flows. They're staking, they're gambling a little more, they're farming on Athena and doing things like that. Whereas if I think about like our users who use Bitso and LATAM, like they're not doing that, right? They're kind of a little more down the narrow. And I think it's really interesting because we can take lessons from Asia where there's more experimentation happening and kind of port them over to different regions worldwide and, hopefully have a little more similarities worldwide.
I really appreciate that. Maybe Christian, Yellow Card went multi-country very early, right? And a bunch of founders in this room. Corridor diversification, country diversification is probably a decision on their minds. Would be curious from your perspective, what were some of the biggest benefits and challenges of this multi-country strategy, and how has it really shaped Yellow Card's competitive position?
Yeah, I mean, on the benefit front, the biggest problem in Africa is that every single country has like their own governing bodies that have their own rules and their own processes, and it just takes a really long time just to get things done, right? There's this term called TIA. This is Africa, where it's just broadly known that everyone talks around just says, all right, you're late for some reason, TIA. And the thing with that is that like it applies to just how you do business there, right? You want to get a license in Kenya, that's going to take you 1 year, right? Just think about their mind. There's no fast tracking it. You just need to spend 1 year on it. So I think the biggest thing is that like going multi-country in Africa, you kind of have to do it because you just don't know when you might get debanked, delicensed, whatever it may be. The rules can easily change. So it's really a function of like hedging for your business, but then two, also being able to capture different kinds of flows, right? If people are moving money from Nigeria to Ghana, you want to be able to capture that flow. So you kind of need to support Ghana on that end. If you're, one day the president's son gets scammed from some meme coin, now all of crypto is illegal, which by the way, this has happened. And so now the entire yellow card team is getting arrested because of that, not because they did anything wrong, just merely because they're crypto. Well, you should probably have another country you should be able to operate in. So a lot of it is just a mere protection mechanism for yourself so that you just don't have your business wiped out in one day. But then as more and more people leave their countries or go work in other areas, kind of similar to LATAM, right? A lot of Argentinians go to Brazil to work, they'll go to Mexico. You want to be able to capture those flows as well. So the pros of it is hedging. Now, the cons of all this stuff is, it just takes time. You just don't know what the process is really going to take. You do have to educate a lot. You have to open sandboxes. Yellow Card is right now in 20 countries of the 54 in the continent. They're going to be in a lot more by the end of the year. Now, the thing is, like, a lot of these countries never even had any rules or regulations. So it's like they've been smart about actually positioning themselves, educating regulators, building sandboxes. So not only they benefit, but also other entrants in the market as well can come in and benefit from these new rulings in place. So, cons is just, it takes time. It's also just going to be a pain for you to deal with some of these people and educate them on it. But, in the long term, it benefits because you're not just stuck to one area and you might just get your business shut down because of that reason.
Super helpful. Anybody have any?
Yeah, I 100% agree. And I feel like in Latin America, you have less of a need to have all of the countries at the same time because you have an actual percentage that is very meaningful in both Mexico and Brazil that make it worthwhile to integrate with a specific partner in either of those. But I do think that you have a similar scenario where until now you didn't have to have regulations to operate with stablecoins, but that's coming soon as well. But you did have to either work with a player that was fully regulated to have access to accounts, to have access to PIX and to the other local payment systems there. And regarding Argentina to Brazil flows and vice versa, back a while ago, you had Argentina essentially being in a steal, right? So all the Brazilians would go there. They would feel like kings because the currency devaluation was insane. And currently, it's actually the opposite. So you have a ton of Argentinians. They go to the south of Brazil. They essentially buy everything there. And we are seeing most of those flows now flowing through stables. So we have companies like Dollar App, like Nomads, Eldorado, Felix, Pago, and so on. That's originally they were essentially moving money from Brazilians into accounts abroad. But now they are actually having all of those Argentinians and Mexicans that would have that account use case essentially for USD and being able to spend money in the US connected with PIX through those companies in a way that now they can off-ramp into from USDC, USDT into BRL and use the ecosystem that the Central Bank of Brazil built for locals in a way that you can pay for anything that you're buying in a bakery or that you're going to a club or to anything else there that would only accept PIX and local currency with your USD account that is stable backed, right? So we are seeing dozens of millions of dollars every day from foreigners that are now spending money with PIX, which is very interesting.
Really helpful. We've talked about a bunch of different use cases across business and consumer. It'd be great to get your guys' perspective on where has adoption been most prevalent and where will stablecoin infrastructure benefit folks the most on the business side or the consumer side?
Sure. Yeah, I mean, I think the first big pocket of adoption we've seen has been really consumer. It's been peer-to-peer remittance. I think two places peer-to-peer. One, there's been pretty amazing like peer-to-peer networks to actually on and off ramp. Like Binance has done a wonderful job with this through time. Whether good or bad, you can debate. But they've actually gotten stablecoins and wallets in the hands of many people. The second place is many local exchanges are now kind of facilitating the on and off ramp for individuals when the original thesis was for them to just be the cryptocurrency exchange. And we're seeing this worldwide, which is interesting. I think the second place where we're starting to see adoption is really on like the enterprise and business side. And it's mostly been payments within a company. So they're using it to pay out vendors or they're using it to pay, their employees worldwide, and they're using it to repatriate funds. I think the place we're really looking to see is market pull for basically the next step, which is paying vendors in your supply chain with stablecoins. And that's really interesting because now you have to get more than one party on board with this, different AML, different compliance, different risk and fraud. Like, our friend from QED was saying earlier, it's really important. And I think as you bring more parties into the system, it's actually much harder to coordinate and do. But going to be really interesting. And there's a lot of amazing tech that's there and actually some amazing big global companies that are starting to experiment with that. And that's super important because that kind of signpost to the rest of the world, like it's okay. And that's important.
For us, as of late, we've been spending a lot more time on the business side. It's also as a way to actually channel to get customers on the consumer side. I think kind of generally the issue with consumer, and we've seen this with like fintech banks and neobanks, is that like they're super expensive to acquire a customer. On top of that, like generally these users have multiple banking services and apps, so they're generally quite fickle, and they're willing to leave your platform pretty quickly if they want to. So you typically have to cross-sell them a bunch of other services so they don't end up leaving. But I think the beauty, at least with the business side, is that one, the ticket sizes are a lot larger. The volume is generally a lot more consistent, right? If you're paying employees, every 2 weeks you have a bunch of things you have to pay for. Every month you have subscriptions. And then at the same time too, generally once these businesses, they do a whole evaluation of a lot of different vendors, and they're going to pick you. And for as long as you service them well, they're not really going to leave. The churn is not going to be as high, and you're not going to spend as much trying to keep them as a customer. So I think the business side is really exciting for us. And I think, it's just going to be, when you think about consumer payments, I think it's about $100 trillion of payments a year. Consumer is probably in the 20, and the business side is way even higher by multiples of size. So it's definitely just going to be an area where people are going to, try to capture a lot more activity. And so that's where we're going to be spending more time on.
We are also only B2B focused, and although we enable a lot of consumer plays through our platform like Dollar App and AstroPay, I do think that I share a lot of what you just mentioned. When you are operating with an enterprise customer, you essentially have to service them really well, have amazing products and APIs, but they will push $100 million, $50 million with you every month. And it's consistent with a lot of the global account plays that you have now on the consumer side and, dollar-based cards. It's essentially a user acquisition type of play. And I think that over time, it really capitulates in a sense that it becomes harder and harder to acquire the user and to keep them over time as well. We have really seen that in Brazil. We service most of them, so for us, we don't really care who wins. But I think that dealing with consumer plays is usually a lot harder to maintain that customer base over time. And since the beginning of the company, we really dialed in getting that company that not only wants to move money once a month or once a year, but really the heavy use case where we are a big difference at the end of the day for that company in the quarter. We are allowing them to have 30% more revenue, or we are enabling them to essentially do a corridor that otherwise they wouldn't. It's actually very funny when you go talk with a Brazilian bank, for example. You ask them, I want to operate, buy crypto, USDC from my Brazilian operations. And sometimes they ask you for the hash even before you have the operation. And then you try to explain to them, but usually the hash is after you actually buy the crypto because you have to pay the exchange and actually withdraw. And they say, oh no, without the hash, I can't do the operation. I need that prior to closing the FX. And there's a lot of gap in the financial institution understanding of crypto still. So I think that a lot of those use cases that leading companies are doing are only possible with either companies, banks that are like similar to Cross River and Leeds here in the US, or essentially through fintechs that have done the hard work and acquired licenses in those local countries.
Yeah, you bring up a really good point that a tremendous amount of core infrastructure is really needed, and each region has different set of requirements from on and off ramps, FX, liquidity, and compliance. Maybe, Christian, you can speak a little bit about Yellow Card's experience, and even from an investing standpoint in Africa, what core infrastructure do you believe is most necessary right now?
I guess from like the stablecoin orchestration side, or just like generally?
I think, regionally in Africa or more broadly across the stablecoin ecosystem, in order to achieve the largest benefits we can from this infrastructure, what do we need to put in place?
Yeah, look, it generally seems like the tech for the most part is at a really good positioning. There's a lot of different stablecoin chains, seeing more issuers by day. So I don't think there's like that much more additional value you get from them providing those services. I think the biggest thing for them is just making sure you get the right licenses in place to operate, get the right banking partners, because they get debanked all the time. Even though we're getting a better position in the US, they've been debanked already since the new administration, so it's kind of a pain. But I think, making sure you have access to good FX liquidity so that you're not taking too much risk on the FX side when you're doing these trades or payouts. And then, making sure you have the licenses. Like those are like the two biggest things, because if you don't have the FX and you don't have the liquidity on that, then like, great, you can't fulfill that end payments. And then next thing you know, that business enterprise you're supporting is not excited to work with you because you said you can do $100 million of volume for that specific trade or that sort of route, but now you can only do 20. So it's just, it's kind of you oversold and didn't actually lead up to the promise. So I think the biggest thing is just making sure you have the banking partnerships, which allow you to get the better FX rates and then also gives you liquidity over time too.
Sure, happy to add. I mean, I think you touched on a few things that I would agree and double down on. Like local rails are so important. That actually creates like a moat. And I think then that's something you can bring a value to your enterprise or your retail customers, whichever you go after, which is important. Having a user base, I think people don't talk about this enough. I mean, as a VC, we've seen so many retail-focused apps pitch us. And they're amazing ideas. Some are doing really well, but it's also really scary when you see a company like Nubank seemingly overnight turn on, dollar-based accounts using stablecoins for all their users. Like that's a scary proposition. So users is so important in, cross-selling and creating sticky moat. And then the last, I would just double down on what CK said, is having the liquidity to fulfill the promise to the customer you made is what's important, because that's what they care about is like, can you handle the trade when their volumes ramp up? And that's more than just like a balance sheet. That's having relationships with OTC, market makers, dark pools, things like that. Even bringing more capital from on-chain, like in Uniswap or other, to make it happen is really important. So I think that's where orchestration comes in actually, is enabling better and deeper and more predictable FX. Maybe less so how we've been saying it typically, which is just kind of the initial kind of on and off ramp. I think that is going to be handled by those who own the local rails.
Yeah, you brought up something, and maybe Bernardo, you work with some of the larger financial institutions in Latin America, dLocal, Conduit, et cetera. How do you think about differentiation in your business and creating moat?
So I do think that a lot of the problem with actually fulfilling that liquidity and being able to settle payments is a reliance on many levels. So sometimes you are using a platform, but in reality, that platform uses another, that uses another, which uses a broker, that uses a bank, right? And you never know how many layers are actually there when you are using that as a consumer, for example. So having as close to the fully regulated player as possible is really interesting. I think that's where borderless, for example, comes along and enables the end user, the businesses to tap into the best possible player in that region. And hence why we are also very excited about the Circle Payments Network and other plays that we are seeing now. But I think for the most part, those companies that are getting into a market, they might just get the easiest, or at least the ones that they know. And there's a margin play here, so they are paying a lot more because there are so many levels to their operation. But also, the farthest you are from the license owner and the one that actually executes the payment, the more likely it is that you might have problems and that you won't be able to fulfill that. So what we did in Brazil is we got 2 different bank partners where we have exclusivity over their operations. So they had other plays. So essentially they did a lot of like consumer lending and things that are more vanilla, but they did have the fully regulated bank license. They did have the FX license as well. But they didn't really have the technology like APIs, or they weren't even enabled to handle tech companies. So very similarly to what Bridge did in the US, they worked with Lead very closely. But as you know, Leads and Cross River wouldn't probably give Bridge exclusivity over their operations because they service so many other companies like Circle and a lot of other crypto companies. So the main value that we brought in that relationship was, okay, we already have a lot of volume. We are keen to create the APIs from the ground up, connect with the central bank, and essentially create a new business line with that bank. And in return, they gave us the exclusivity to operate those verticals within the bank, open non-resident accounts, and enable foreign companies to essentially use their license. So I think that having best of both worlds, essentially amazing APIs and a company that really understands your payment flows, the compliance framework that's necessary to actually operate that at scale, and also having a fully regulated player that is financially capable and regulatorily capable of handling those payments is very needed. Because a lot of the banks that we see, they have a cap on the amount of volume they can handle. Not because they don't have the liquidity, it's because they think, oh, if it's over $20 million, then it's a compliance risk. Because they don't really understand what they are handling, right? So I think that ideally you should get either a bank that is very tech-enabled, such as Cross River, Leads, or working with a company such as Bridge, such as Yellow Card, or you should build it yourself. But are you going to do that for every region? I don't think that's feasible as well.
Super helpful. I think we have time for just a few questions if anybody has questions for the panelists. Here we go, right here.
So you mentioned orchestration. What do you mean by that? Because I've heard it a couple of times now on the panel, and it means particular things in various contexts. So it's really important here for movement of money and what do you mean?
Sure. Well, I'll define a few things. I think typically what is today defined in the market is like what a Bridge or a BVNK or Yellow Card does in certain regions is orchestration, which is basically just going between kind of a fiat balance and a crypto balance, right? I think previously we've always thought of that as like on and off ramps. And the reason is because that's enabled by a banking license or a proximity to a regulator that lets you do that. I think really where those companies are moving is doing much more than the on and off ramp, and calling orchestration like truly the end-to-end flow of money for maybe a treasury operation or paying contractors. And so I think that's everything from what the UI and UX portal looks like, where you're typing things in, maybe where you're typing your contractors' names in, maybe the vendors you're paying out to, and more than one hop from one fiat balance to one FX balance, I think. So really all-encompassing movement of money end to end. And I think right now, as an industry, we've been very, very good at one thing in certain geographies. And I think that's going to grow through time. Great question.
I guess for me, the orchestration is really like kind of what Bridge does, right? You're tapped into some sort of API to be able to mint or redeem the stablecoin, whichever it may be. And there's companies like M0, which you guys are invested into, which allows companies to launch their own versions. And then also from there, be able to move the money effectively within the crypto rails. But really, to me, like the edge longer term is obviously having the end distribution of the specific region, country with the license and all that kind of stuff. But to me, like the stablecoin orchestration is just being able to mint the coin and then move that money through the crypto side. So that's kind of like the easiest portion now.
And right now, I think it's usually fiat to stablecoin, usually USD based, to then fiat again. The ideal scenario would be to have local stablecoins that actually have great liquidity to convert into USD or USDC, USDT, which I think is what's really lacking for emerging markets, local backed stablecoins. Because right now they are kind of missing the point, and it's what we are going to try to solve later this year. Users and businesses, they don't really want digital BRL because they want to spend it locally. They want digital BRL because they want to convert 24/7 into USDC, into USDT. So that really comes into play when you can actually do that on chain, and you can have orchestration not only between the local players that are eventually going to off-ramp that, but also between the currencies so that you don't have the currency fluctuation, so that you are able to actually settle from one country where banking hours are currently not available, right? Because it's a holiday in that country, but you have that stable coin, and now you can settle into the US, which is a working day.
Awesome. One final question. Anybody? This gentleman over here.
I want to dive in on credit side, which is kind of sort of, I'm kind of curious, like, I understand the concept that stablecoins in emerging markets offers dollar stability. Do the folks, consumers and businesses in those markets actually want dollarized coin? Because if they're spending it, do they want those loans effectively in their local currencies? Or, now just an option to get around or take that one.
The question is around demand for dollarized credit.
That's a good question. I think it's going to be really geographic specific, of course. Maybe I'll answer from a few directions. I think we're seeing a lot of demand for folks that are being given stablecoins, right, in some form, to then spend it on payments. And the second place we're seeing a lot of demand is to use it to get access to other financial products that maybe they wouldn't have been able to have access to outside of having a US bank account. And credit actually hasn't been high on the list. It's actually been more investment type products, stocks, bonds, token on assets. There's a really interesting case study that I won't pretend to be the expert on, but there's a business called Cachea operating in Venezuela, which is basically giving credit to Venezuelans through, a tokenized asset. And it's unbelievable. That's a really specific example, right? Because there are a few countries unlike that one. But I don't know. I think credit on chain has been interesting. There's another example, maybe you can speak to it, but CloudWalk in Brazil is doing some really interesting stuff with credit, and they've kind of made their own payments network essentially. And they're using a stable asset that is not necessarily a crypto any of us know, but it's their own permissioned one. So I think there's some interesting use cases here. And the idea of a blockchain and something tokenized can give access to the credit, but the actual innovation has been in kind of describing what that product is and the usability rather than pure demand for it or not so far. And it's very geographic specific. So high level answer, but many different specific case studies to dive into next.
Nice. I think we're actually at time, guys. If you guys would join me in thanking these guys for taking time on this panel.